Maruti Suzuki built its empire in petrol and practical mobility. For decades, that formula worked brilliantly. Affordable cars, trusted brand, low running cost, wide service network, massive reach, strong resale value. It became a default choice for millions of Indian families. But market do not pay for the past. They pay for the future. And today, one uncomfortable question is growing louder. Has Maruti arrived too late to the biggest shift in auto industry? Electric vehicles. Because if the answer is yes, this is not just about one new model. This becomes a long term valuation story, a market share story, and a wealth creation story for investors. This is analysis and not any kind of advice. First, let's be very clear. EV adoption in India is still developing. Internal combustion engine vehicles remain dominant. Charging infrastructure is improving gradually. Battery cost still matters and mass adoption will take time. So, this is not a story that Maruti suddenly will disappear tomorrow. Serious investors should avoid dramatic nonsense. But stock market do something important. The price change before change became obvious. That means a company seen at best position for the next decade can gain valuation support years before the full profit arrives. This is why EV debate matters now, not later. Why does Maruti face extra pressure in this narrative? Because when a market leader is dominant in old system, transition risk became larger. A smaller challenger can gain share by winning the new category. The incumbent has more to defend. Maruti's traditional strength were built around scale, manufacturing, low cost engineering, dealer reach servicing, and trust in fuel efficient petrol cars. Powerful strength, but not automatically sufficient in EVs. EV competition introduces batteries, software, charging partnership, new supply chain, electronic intensity, and a different customer decision process. Brand still matters, but the game board changes. Now look at the perception. Tata Motor gained early visibility in Indian passenger EVs. Whether or not current EV volumes are huge, early leadership can shape consumer mindshare. Investor notice that a company associated with the future often receives more strategic attention than one associated mainly with the present. This is where Maruti risk is not only sales risk, it is a narrative risk, and narrative can influence valuation multiple long before accounting number change. But now let's be balanced. Why might be fear overstated? First, India is price sensitive market. Mass EV adoption depends heavily on affordability, battery economics, and charging convenience. These are exactly the area where Maruti cost discipline and mass market understanding could be an advantage if execution is strong. Second, distribution scale matter in any power terrain. When adoption broadens beyond early enthusiasts, trust, service access, and financing can become decisive. Maruti already owns those strengths. Third, being late is not always fatal. In business history, many early pioneers created market, but later leader captured profit through better scale, lower cost, and broader reach. So late entrant does not automatically mean loser. The real question is execution quality. Can Maruti launch competitive EV product at attractive price points? Can it build supply partnership intelligently? Can it protect margin while transition? Can it use scale faster than rivals? Those questions matter more than headline. Now think like an investor. Bull case scenario. EV adoption expands. Maruti enters strongly. Use scale to lower cost, leverage network trust, and convert existing customer into EV buyers. In that case, today's fear may look exaggerated. Bear case. Competitors strengthen brand leadership in EVs. Customer perception shift permanently. Maruti responds slowly and valuation premium migrates elsewhere. Base case scenario. EV grows gradually. Maruti remains strong in ICE while building EV presence over time. What should investor track now? Number one, actual EV launch pipeline and execution timeline. Two, pricing competitive. Third, battery sourcing and localization. Fourth, dealer readiness and after sales ecosystem. Fifth, customer acceptance and not only launch headline. Sixth, whether EV growth is incremental or cannibalizes existing profitable model. Final takeaway, Maruti is not automatically too late, but it no longer has the luxury of being passive. In mature industries, leadership is defended through adoption, not memory. The market is asking whether Maruti can dominate the next era the way it dominated the last one. If yes, current fear may become opportunity. If not, this could be the beginning of slower re-rating. In investing, the biggest risk is often not current weakness, it is underestimating structural change. And that is why Maruti's EV story matters now. Thank you very much. Make sure to subscribe the channel, like the video. See you in the next video. Thank you.